Howdy, Jacob here. The next company we're looking at has ticker symbol SKM. It is company 123 of our dividend yield stock screener. It's in the wireless telecommunication service industry, and it looks like they provide wireless telecommunication services in South Korea. It was incorporated in 1984, $8.1 billion market cap with a $12.6 billion enterprise value with a 6.6% dividend yield right now, so pretty substantial yield. Hits our metric of 4%. Return on invested capital recently has been mid single digits, but has been as high as low double digits. Gross margin has actually increased over a 10-year period from 83% to 87%, but operating margin has decreased from 12% to just under 10%. And let's look at some of that net debt here. We have 1.4 with short-term investments. We're looking at about $1.6 billion in cash-like products, but we have $1.6 billion in short-term debt and $5.6 billion in long-term debt. $1 billion in capital leases, not too concerning there. Let's look at what that is in relation to cash flow. So $1.7 billion 2022, $1.8 billion 2021, $1.8 billion in 2020, and then lower in 2019 by quite a bit, 600 million. It's maybe an average of, let's say, 1.4, 1.3. Yeah, let's say 1.3 billion 5-year average. They do have a massive amount of capital expenditures, so you do have to take that in consideration. This type of business requires a lot of reinvestment just to sustain the business. And I mean, there are some growth in most companies' property, plant, and equipment figures, but majority of it is likely just sustaining the current business. And so, yeah, we are seeing cash from operations still quite a bit higher capital expenditures, but this is a capital intensive business, which can be seen through their property plant being super high. In relation to revenue, earnings, and such. And so that is good to see that they have about a I don't know what I said, maybe $1.3 billion here. Their dividend payout of 6% is actually less than 50% of their 5-year average. And they have been focusing rolling 12 months in the last 2 years to pay down some of that debt. Outside of most recently, they've just been increasing it for the most part. And so it's good to see that the company's paying down a bit of debt and then their dividend payout is less than 50%. Otherwise, they do use a little bit of cash, usually each year, to make acquisitions, make investments, and then make intangibles, I guess, buy intangibles. And so I think we're going to start getting into the grunt of the assumptions here. It looks like it's a declining business. We see 15.7 billion 10 years ago down to 22 billion, or in 2022 13.4 billion. And yeah, there was a devastation here, devastation here, devastation here, but there have been a lot of acquisitions as well to subdue that. And so I think we can honestly say -1% a year, and then a business that's has negative growth, we actually want to be pretty conservative and say, what about a 9 PE price free cash flow? How does that look for them? As for margins, 11 and 10. Let's see what impact interest would have on them. So let's say 6 billion in long-term debt. 2% off of that would be about uh, 12 million. So let's say 120 million. 120 million is a 2% impact to their long-term debt if they had a 2% increase in interest expenses, and that is going to be we said 1.3 billion over here, so less than 10%. So I'll bring these down probably 1%. So let's try 10 and 9. And again, what I did there I took the average of the 5-year earnings and free cash flow. I looked at how much a 2% increase in interest expense would cost them, and it was slightly less than 10%. So I shaved off roughly 1% on each margin. And then let's say 0% share change. I think that because it's a declining business, the capital allocation towards a declining business should be giving the money back to their investors. And so I would think that they would increase this dividend, and it looks like they actually haven't in the most recent 2 years. And so, although I think it'd be smart for them to increase this dividend, it doesn't look like they will. So I think I'm fine with the assumption that they're going to keep it the same. And that gets us to a stock price that needs to fall 25% before you get a 15% return, given these assumptions. I think that the dividend yield is pretty substantial. It is out of South Korea, but I think the margins are pretty safe here, and a 6.6% dividend yield is pretty great. If you can get a little bit of price appreciation with that, then this could be a great investment, especially for someone who's just looking for excess cash or retired who wants that great yield and then can also get some price appreciation through the stock price increasing a bit. But for now, just waiting a little bit before I do more research, and I hope everyone has a great rest of their day. Thank you.